This video discusses the importance in exit planning of having both the business owner and the business ready for exiting in advance of the planned date to sell or transfer ownership of the business. It will also present several approaches to measure the readiness of the owner and the business to exit. One analogy to exit planning is launching a spacecraft into space. This requires a well-coordinated launch team, proper timing, and the right payload. Similarly, in exit planning, selecting the right time to exit the business is critical. There are three distinct and different timing cycles that influence when an owner should sell a business. 1, the investment market. 2, the life cycle of the business. And 3, the owner's life cycle. Each of these run independently of each other. The goal is to exit a business when these are at their highest average point. Multiples in the investment market go through cycles, typically dependent on interest rates and the economy. Businesses go through their own ups and downs. Best time to sell a business is when the business is growing and expected to grow in the near future. The owner's energy and interest in managing the business also has ups and downs, not just when considering retiring. Unfortunately, most small privately held businesses don't sell, and most owners do not prepare in advance for their exit, resulting in either not selling or selling at a price well below what could have been generated with proper and timely exit planning. Historically, 70 to 80% of private businesses put on the market don't sell. Historically, only 30% of all family-owned businesses survive into the second generation. 12% survive into the third generation, and only 3% operate at the fourth. Only 5% of business owners surveyed had a traditional advisory team. Only 24% of business owners surveyed stated that they are familiar with their exit options. Almost 50% of business owners surveyed had no thoughts what they would do after they exit. Only 1/3 of business owners have a contingency plan if they should get ill, die, or otherwise exit. Only 14% of business owners surveyed had any formal education on business transitioning. There are many potential elements in exit planning, as shown in the diagram on the right side. But one of the most important elements in the discovery phase of exit planning is determining the readiness to exit and the attractiveness of the business for sale. For each of these three readiness factors, we will present critical questions that need to be addressed. We will also discuss how to measure an owner's readiness, the business readiness, and the business's attractiveness to prospective buyers. One important factor is to determine if the owner is ready to exit their business. It's not uncommon for a business owner to go through the exiting process, secure a buyer, and then determine just before the sale closing that the owner really doesn't want to sell. This situation is often caused by the owner not having a clear vision of what they'll be doing after their business exit. Other issues in owner readiness deal with proper personal financial planning. Have the expected income and estate taxes been estimated? Does the owner need to create one or more trusts to minimize these taxes or to control who will own which assets after the sale? And the Institute have tools to help a business owner better measure whether the business owner is ready to exit. John Warlow and the Value Builder System have developed a scoring tool, the Pre-Score, or Personal Readiness Score. This evaluation tool is an online questionnaire that evaluates a business owner's readiness to exit their company on a personal level. The Pre-Score determines at-risk areas and provides personalized recommendations for improvement. The Personal Readiness Score from the Exit Planning Institute was developed by the Institute to help business owners self-assess their readiness to exit. Determining readiness is to determine if the business is ready to sell or transfer ownership. Are all corporate documents in place and readily accessible? Has the company conducted legal due diligence? Are the company's financials in proper format and summarized for presentation to potential buyers? Does the company have a presentation that presents the company's value proposition to prospective buyers? The Exit Planning Institute provides a self-assessment questionnaire that identifies a number of areas that help determine if a company is ready to be offered for sale. A key element in exit planning is identifying those areas that need to be addressed and then helping the owner establish action plans to address. The next factor in exit planning is how attractive is the business to a prospective buyer. This often is one of the hardest factors to address by the owner, since it requires the owner to think like a buyer, not as the owner and manager of their own business. Each buyer has their own method for evaluating potential acquisitions, but it is common that most buyers view the potential acquisition primarily from a financial viewpoint. Return on investment is key, and evaluating risk factors that might impact future earnings are the primary drivers. The task of the exit planner and the owner is to conduct the buyer's evaluation in advance and address the many risk factors that will be of concern to the buyer. This includes the company's market share and positioning in their market, evaluating whether the company's revenue and profits can grow after the acquisition, how the company operates and how it will likely operate after the owner exits, and evaluating risk related to customer or vendor concentration or critical key employees. The Exit Planning Institute provides a self-assessment questionnaire that identifies a number of areas that help determine how attractive a company is to prospective buyers. A key element in exit planning is identifying those areas that need to be addressed and then helping the owner establish action plans to improve the attractiveness of the company. John Warlow and the Value Builder System have developed an entire methodology on how to identify and improve each of 8 factors that they have identified through research as having verified impact on the sale multiple of a business. Either of these 2 self-assessment tools can be used to establish a value improvement project for a business owner starting an exit planning process. So let's summarize the information in this video. There are 3 cycles that need to be considered in determining the best time to sell: the owner cycle, the business cycle, and the investment market cycle. When considering selling or transferring a business, there are 3 factors that need to be addressed. Is the owner ready to sell? Is the business ready to sell? Is the business attractive to potential buyers? Both the Exit Planning Institute and the Value Builder System provide scoring questionnaires to help identify areas that need to be addressed and help establish action plans to improve in each of these areas. Working with exit planning advisors and other exit planning professionals can help the business owner establish and execute an exit plan that can substantially improve the value of a business.